Hello and welcome to today's New Capital's webinar, 2024 Review and 2025 Outlook. I'm Catherine Barr, the Director of Communications at New Capital. Thank you for joining us today. And for Q&A on this webinar, we're going to change it up a little bit today. You can feel free to type your questions into the Q&A tool or the chat tool in the webinar menu at the bottom of your screen. And we will actually be pausing at the end of each section to allow any questions to be answered for that relevant section. So be thinking of your questions and feel free to type them in during the presentation in the different sections. Okay, also, as we are getting started today, we are going to launch a quick poll. Let's see if I can do that. Okay, so you should see a poll up on your webinar screen now. Feel free to answer the questions on there as we are getting started here. And Leonard will be reviewing the results of the poll during his presentation. Okay, and now I am going to get us started by reading the regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And I will turn it over to Leonard Golub.
So as Catherine said, we're going to do something a little different. We're going to do Q&A after each section today.
So we've got 14 out of, okay, so we've got a 93% participation so far. So if you want, we can go ahead and end it and see what the results are.
Okay, that's fine.
So I'm going to go ahead and share those results. So everyone should be able to see them.
So concern about markets, somewhat concerned is how well, frankly, it's a majority. 57% of people voted, and I don't think that's abnormal. I think a lot of people are feeling a little jittery about markets. Some of that is in evidence with market performance that's recent over the last several weeks. We've had softness in markets, and we've had interest rate movements that, especially in U.S. Treasury bond market, that's been concerning. We've gone through an extraordinary political period and are about to enter into another extraordinary political period, and all this combines to cause concern, and that, we're hearing that from people. I asked about Bitcoin, somewhat opposed, despite Bitcoin's, and I asked, probably been a couple times over the last years, whether anybody would be interested in Bitcoin in a portfolio. It really wasn't until really exactly a year ago that there was a way for us as advisors even to put it in the portfolio. When the SEC finally permitted it to be put into funds, prior to that, there were restrictions on Bitcoin and other cryptocurrencies, and the SEC actually lost a lawsuit in December of 2023, and were basically forced by the court system to permit the formation of funds that would hold actually hold the digital assets in the fund. Before that, it was only really derivatives that were able to be formed into portfolios. And what we see here in this poll is that not a majority, but a plurality are somewhat opposed. And we don't have anyone very in favor, at least on today's call. But I'll talk about it at the end of today's presentation when I talk about some potential model changes that we're making, and that includes the possibility that we would add a Bitcoin holding. And I'll talk all about that and why that might be. But this still shows that it's an area that is not without its concern. So we'll talk about that. And then how do people prefer to receive communications from us? Vast majority through email and not text. And we'll talk about that because we're making some changes where we actually think that sending you some things via text may be a better way to send it. But we wanted to find out. So thank you all for answering these texts. Everybody knows about the wildfires that are going on in California. I'm sure many people have family and friends, and we sent a notice yesterday with some organizations that Fidelity Charitable has listed, and we list them here again. And so we hope that if you are so moved or affected, or anyone you know is affected, to take a look at some of these organizations. Any assistance, I think, is going to be helpful there in California. We, especially here in Houston, having experienced repeated natural disasters in the form of hurricanes and tropical storms, certainly know very well what it is for an entire municipal community to be impacted on such a widespread scale. And so really, this is just a reminder that if you're able to help, that these are some organizations that are working in the area. And if you want more information about specific organizations, we can get that for you and get profiles for them and so forth. NCM 360, we continue to do a tremendous amount with it. Quarterly, annual reports are available, have now been published to your login. We started in the second half of last year putting onto NCM 360 very extensive meeting reports. After our meetings with you, this becomes available. We're using an AI assistant, and our meeting reports, the quality of them has improved so much. I mean, we're producing multi-page reports on our meetings, and after you meet with us, we work to make sure that the notes are straightened up, and then we put them on NCM 360. You get a notice that they're there, and so you can find meeting reports there. We have also recently transferred our budgeting, our household budgeting process, so that it's no longer on a spreadsheet and we send you the spreadsheet and maybe you can work the spreadsheet or not. Catherine did a terrific job making our budget capability reside in NCM 360. I'm very, very, very excited about a new feature called Reminders, and is really the reason that we asked the question about communications from text or email, because this new reminders capability will allow us to put in all kinds of reminders for you. Reminders about tax filings, reminders about estimated quarterly taxes, reminders about things that go on with if you are a business owner or have entities, LLCs, and need for filing, reminders about funding charitable accounts, reminders about contributing to IRAs, on and on. Reminders about our quarterly meetings. We be able to put in and can put in when you would like to have your regular meeting with us. And so we are actually thinking that these reminders, just because they're short things, might be better through text. And that way you'll have a whole feed coming from us and can look over your whole list of reminders. If we send the reminders, and we do, and we can send both. If we send them through email, then they may get lost with the whole pile of email that everybody gets. But if it's coming from our official text, they'll all be in a list for you, and you can go back through your reminders. And then finally, I just want to mention, if anybody themselves may have thought about it, that the California wildfires offer us all an opportunity to think about storage of our important documents and our important information. I have no doubt that many people in Los Angeles affected by the fires whose homes burnt down, many of them probably lost not just their homes, but also very important documents. And so I again remind everybody that one of the goals of NCM 360 is to make sure that critical documents, that you have critical information, um, are stored in a way that you can get to them quickly should you need to. And in the case of NCM 360, we have the ability to provide assistance as well. And so no other firm has anything like NCM 360 because we built it from the inside here. And so, again, I just remind everyone that if that concerns you, if you look at what's happened in California and you think, I really need to make sure that I have a good digital storage, well organized, something that our financial advisor can get to. And of course, we also have a sharing feature built in so you can share selected parts of your information with trusted parties, family members, then NCM 360 is there to be able to do that. But the data has to get loaded. And so if you're interested in either beginning loading of your information or enhancing what you've already done, please let us know. Casey Moss is in charge of doing that and helping clients do that, and we can set up a time with you. Political survival services, the basket of things that we've built. We've talked about this a lot: Swiss accounts, residency and citizenship by investments for those of our clients who are concerned about our country. And we have some who are and some who aren't. Perfectly fine either way. We're here to serve and give people options. That's it. And we've had a couple of clients who've been interested in bullet point number 2 and are doing some investigations there. Our global portfolios are there to diversify people as much as can be diversified, both in fixed income and in equities. And then also any sort of relocation services. We've had some clients who've been making some decisions in life to change where they live within the United States. And there are large financial considerations that go along with that. We're very good at helping along that process. Okay, I'm going to have JC join us now. Many of you, if not all of you, have been getting some notices about something called F cash and your core position. Those notices, I think, began to land just a few days ago, and we've had a lot of emails coming in to the effect of, what is this? And so JC is going to explain what this is. It's an important issue.
Mm-hmm.
And so turn it over to JC. And then after this, we'll be available for questions. And they'll probably, if you have questions about the things I've just talked about or about this, we'll take those before we go on to the next segment. Okay, JC,
All
core
right.
cash position.
Good afternoon, everyone. So Fidelity's core cash position. Some of you may have been asking, what is a core transaction account? And what that is the cash holding in your Fidelity account. So that's where deposits sit, dividends that are paid sit. When we sell stocks, the cash from the proceeds from those sales will sit until it's either withdrawn or it's reinvested. And you all are used to a money market fund that is held in the account, which it still is right now. And it offers higher yields, especially competitive yields compared to checkings and savings accounts. But over the past year, Fidelity has been phasing these out for new accounts. And now this year, it looks like sometime between February and June, they will also start phasing out that money market core position option in taxable brokerage accounts. So first, it's only in taxable accounts for now. We'll see if they move on into qualified accounts. But what that means is all of your deposits and cash will be sitting in this F cash, which is yielding about 2% right now. So that's about 2% less than what you're used to on the current money market. That's at 4% or so right now. But the good news is that we're going to be here to manage around that. So whenever there's cash sitting in Fcash, we will have a daily report that lets us know if there are balances in Fcash, and we will move it back into the higher yielding money market funds for everyone. So it has no direct impact on how your account functions or operates. It's simply the yield that is being offered in that core cash position.
And the question that arises first probably is why? And the answer is Fidelity wants to make money. They want to, and what we're talking about is also known as a sweep account. It's where cash sweeps into, right? And the account that most have been seeing is FDRXX, the Fidelity Government Money Market Account. It yields about 4.5%. And Fcash is yielding 2.5%. So it's a couple of percent difference, very meaningful, especially on larger cash balances. And Fidelity wants to make more money. It's just that simple. They want to put clients into Fcash, and then they want to go invest the cash and make a spread of a couple of percent. Fidelity, is massive as it is, if they add all that up, then Fidelity would make a 2% spread, positive spread on the cash balance in all these accounts across their entire platform. They're in all their accounts as one of the largest financial companies in the United States. So what it means is that cash is not any longer automatically going to go into, as JC said, into the money market. We are going to manually have to do that, and we're going to do that for our clients. That's why bullet point number 4 says NCM to the rescue. Now, JC, we're not going to move every last penny, right? And we're going to have a threshold. So let's talk about that. What we're going to be looking, what's going to trigger us to act, and what that number is, we've decided.
Yeah, we've talked about $1,000 threshold. So again, we'll run that report daily. Anything over $1,000, we'll go ahead and put the whole balance into FDRXX. But there could be dividends paying out for $30, every day, and that's just, that would take a lot of manual transactions to get that all in.
Yeah.
And
so what? Yeah, go ahead. Sorry.
I was just going to say over a 1 year period, the yield that you'd be missing out on that, less than $1,000 balance it's de minimis. So
yeah. So we don't want clients to call us and say, "Oh, I've got $30 in Fcash. You've got to move it." Okay. So this is the deal that we're trying to make with you all, is we're going to take care of this and work around it. It's one of the great reasons to have a financial advisor. But we don't want, if you have under $1,000, we just want you to accept that's okay. It's not a big deal. 2% on 2% on $1,000 a year is $20, and so in the span of things, $20 over the course of a year is just not that big a deal. Any questions about that? Let's pause right here and see if there are questions about the core cash position. And by the way, we've been having some discussions with Schwab about potentially opening custody with Schwab. There would be some reasons we do it, some diversification reasons, maybe some service reasons. And we went to Schwab to see, okay, well, maybe they've got an arrangement where they're not going to do this Fcash thing, and they're going to sweep cash directly into the 4.5% money market. That might be a reason why you as a client would say, okay, I want to put my money at Schwab. Well, okay, JC, tell everybody what Schwab came back and said about their cash yield, their yield on cash.
So their cash sweep fund, their core fund, offers a yield of 0.05%. So that is still far below Fcash, and of course, well below the FDRXX that you all are used to.
Yep. So we thought, okay, maybe Schwab's going to have some better deal. Not only not a better deal, but far inferior even to the 2% or so on Fcash. So we can't do anything there. We can't solve it by making an arrangement with a custody arrangement with Schwab. In other words, Schwab is even, I hate to use this word, greedier. I don't know that that's the right word, but I'm going to use it, than Fidelity, right? Because if Schwab has clients, Schwab looks more like, you know, the JP Morgans of the world, the banks who pay in many cases close to 0% on cash deposits, right? And then they go out and earn 4.5% on just treasury bonds. So Schwab is even worse than Fidelity, in case you're wondering. So we're going to do this. We've actually, have we told Daisy that we're assigning this to her? Have you told? Okay, we haven't told her yet, so I'm not going to say anything, but it's going to be part of somebody's daily morning routine to check client cash balances, and we'll make trades. One of our clients has asked, why would Fidelity make this change when it makes a lot of work for people? And yeah, the answer is, well, because they want to make money on the spread in cash, and that's the answer. You know, they want to make money. Now, this may not be the end of changes that they make. For example, right, JC, if there is no cash in Fcash in someone's account, they will automatically, as they have been doing, make a draw from FDRXX or another money market fund from Fidelity, right?
It's true. Yep.
But we don't know. They could get to the point where they say that they're no longer going to do an automatic withdrawal from their own money market funds. And by the way, they charge a management fee on those money market funds. Okay, FDRXX has a pretty good management fee. It's like 40 basis points or so.
Yeah, somewhere in there.
So it's not like they're not making any money from a management perspective on FDRXX. They don't only want to make it on the management fee, they also want to make it on the spread between what they can invest, the cash that's being held at, and what they will pay. So, you know, that's the situation. They may come back in a year and tell us that they are now not going to make an automatic withdrawal from a money market fund, meaning we would have to do even more manual work to free cash from the money market when you need cash for a distribution or to pay bills or whatnot. Okay, so we expect that we're going to have to be a lot more active in helping clients manage cash. By the way, you pay us a fee on cash management, so don't feel too bad for us. We are including, and we began to include once cash rates rose back to 4.5–5% area over the last couple of years, cash holdings in our management fee. But just so everybody knows, we're working for that fee now, and have been for the last couple of years to manage client cash. And Fidelity seems intent on making us do even more to make sure that that's the case. They may get to the point where they start to charge on overdrafts. We don't know. We just know that they started a year ago to do it on new accounts, and then they notified everybody that they're going to do it on existing accounts. So we don't think we've heard the last from Fidelity on cash, but for now, this is the situation. Next is 2024 model performance. Everyone may hopefully remember that we added very substantially last year to our models lineup. And we made two big changes. We made a change of adding what we called our market models in addition to our traditional core models. And we also added US only models. And we basically wind up with four main models. There are some others. I don't want to get into those, but the four main models are a core, global, a global core model, and a global market model, and then a US core model and a US market model. The core models differ from the market models in that they tilt toward factors that are the value factors and smaller company factors that over the long term we would expect to have some outperformance, but doesn't mean that they will. And then, of course, US only speaks for itself. So we added those models last year. So we're going to be talking about the 4 different base models in this part of the presentation. JC's going to take it over right now. Okay.
So we will get into the 2024 performance by quarter. And you can see on the bar charts here, the green represents our global core models, the blue, the global market, yellow, US core, and red, US market. And this will be consistent across all of our charts today. This particular performance is based on a 60-40 portfolio, so our model 6. And you can see in Q1, all models had a pretty good quarter. US outperformed international global stocks over that period, but all still up, 4, almost 6%. Q2 was a little positive. And we have our US outperformed the US market. So what I'll say is the market's outperformed here. So that would be the growth, large companies had some outperformance to the factor tilts in this quarter by maybe 1% or so. Quarter 3, all models were pretty consistent in performance. Another really good quarter, close to 6% returns. And you can actually see here that there is a small outperformance to the factors in the green and the yellow. So that was a good overall quarter. And then this most recent quarter here, it's kind of interesting. So you can see that international lagged a bit, and it pulled down the global market, the global portfolios. And then the US market, especially large and growth companies, had some outperformance, eked out about a 1% gain versus about a 1% loss on the global portfolios.
This is the so-called Trump bump. Really is what you're seeing there in Q4. I think this is a very interesting chart because it really encapsulates the entire year for last year and shows you that in any given quarter, the models can do different things given what goes on. So really interesting. Okay.
So we're zooming in here to the Q4 performance again. Let's start on the left-hand side with the model 0. So what's interesting is in the green and blue, those are our global bonds, and the yellow and red are the US bonds. So you can see that global international bonds actually had some outperformance to the US bonds and provided much more defense in this down quarter. And then as we transition,
and that was because US bonds, especially treasury bonds, really struggled with the concern that we're going to get tariffs and that could be inflationary, and therefore we saw a pretty steep rise in US treasury interest rates in the quarter, where we didn't see anything like that in other global bonds right there. Okay, sorry, go on.
Yep. And so as we move into some higher stock equity allocations, we can see, again, what we saw on the last slide is international global stocks had a challenging quarter, down about 2%. And then US stocks rallied, especially large growth companies with a 2% positive performance.
Well, let me correct you, JC. US is in this, right, in Model 8. So US is in these portfolios. It's not that the US isn't in these portfolios. It's that the addition of the international positions contributed to an overall negative performance by the model in the quarter, whereas the US only models, where there was no international, had a net positive. Not a huge net positive, 1%, even under 1% for the US core. The US market portfolios, 1% performance for the model 6 here, 60-40, and this is 100% stocks. Model 10 had a little bit over 2%. So just to make that clear to everybody, US stocks are in these models big time. In fact, it's the majority of the stock positions, 2/3 roughly of these models are US stocks, 66%. These models, the US core and the US market are 100% stocks, whereas these models are about 66% US stocks.
The overall annual performance of each of the models all had a very good year, very strong year. Any of the models from bonds to all stocks, they're at Model 10. And of course, there at the end, we can see that the US only portfolios led the gain there, about 23% returns in the US stock market.
Yeah. If you have a 100% stock portfolio and that portfolio is 100% US market, you know, almost 25% returns, right? If you have a 50% portfolio, right, then your 50% stock portfolio, 50% bond portfolio, then your portfolio did anywhere between 9 and 14%. And if you don't hold any stocks at all, you're all bonds, all of them around 4%.
Quick update on 2024 year to date. So I know it's only been about 2 weeks or so, but we just wanted to show how the year is starting. It's down a little bit. This is as of yesterday. And so everything is down just a little bit. But kind of what we saw, I think it was it Q4 last year?
Mhm.
With international bonds being a little bit better defensively than US bonds, starting on the left over there where Leonard's pointing. They're a little bit more defensive, so down only about 25 basis points versus maybe 40 or so for the US bonds. And then as we go along, we can see, should we highlight the yellow for them first?
Yep.
Let's look at the US core models, the yellow bars here. So
very fast, very fascinating. Everyone should be seeing that the yellow is kind of zagging when everything else is zigging as you get toward these higher stock allocations. So that's the notable thing. Go ahead, JC.
And so what that tells us is even in Model 10 where it's eked out just a little bit of a positive there,
Right there.
there is a value, sorry, an increase in value stocks. So they've performed, pretty well to start the year. And what's down really is, some international stocks are dragging down a little bit. But again, these are very small. I mean, this is less than 75 basis points. So
yeah, these are very small amounts, but it's interesting. What this is saying is that the tilt in the US core model towards small companies and value, it's not that growth companies are not in this portfolio. They are. They're there. They're just that there are value-based companies and smaller companies in a bit more concentration, and that's giving some outperformance as the recent moves in the market have shifted away from the gangbuster growth performance of the fourth quarter, and we're getting more of a strong performance in things like financials, energy stocks, industrials, and that's providing this relative outperformance, though very, very modest absolute performance to the US core, but it's happening even in the global core portfolio as well. Even in the global portfolio, the global core, the core which is tilting more toward the value and smaller companies, is actually outperforming the blue in the global market, which would tilt more toward growth. But all these portfolios have both growth and value companies in here. And you can see we're talking about very, very almost hairline types of outperformance or relative performance.
Now we're looking at the stock valuations within our model portfolios. The first set of bar charts here is the price to earnings. So you can see our global core with the factor tilts, a lot cheaper stocks versus all the way up to the US large growth companies are, 20 times earnings. So
no, again, JC, just I want to be clear. Growth companies are in this portfolio. This isn't a value portfolio. It tilts. It's tilting. So I just want to make sure everybody's clear. I don't mean to jump in, but I want to make sure we're precise about that. the tilts are what are causing the difference in differentials. If we showed everybody a growth fund, for example, the Russell 3000 growth, it would be over 40 times earnings is what it would be trading at. So it's that the combination of growth and value portfolios here is accounting for a almost 21 PE versus where we're tilting toward value, tilting toward small here, 15 times earnings. Yeah. Okay. Sorry. Go on.
Got it. And then looking at the second set of bars here is the price to book. So similar picture there with the tilt to the value in small companies, showing a little bit cheaper side.
Cheaper side, yeah.
And then the dividend yield here in the last set of bars is showing that with those tilts, we're getting a little bit better yield on the dividends. So 2.36. And then as we move along, it slowly decreases about 1.5% dividend yield.
Yep. So lower valuations in the global core, higher dividends, higher valuations in the U.S. market portfolio, and a lower dividend.
And then this is a look into our bond yields and duration. So on the left, the yields, the international global yields there, you're getting about 4.3% yields on those bonds versus a small higher yield of 4.61 on the US only bonds.
Mm-hmm.
But what's interesting is on the duration, if you look at the global, you're taking about a 2.5-year duration for that 4.3% yield. Whereas on the US, you're having to take a almost 3.5-year duration for just a little bit, about 30 basis points more in yield. So much less duration for around the same yield.
And for a point of comparison, if we think about the 10-year Treasury bond, which now has a yield that's, I don't know, where are we? Maybe getting up toward 5%. Let's call it 4 point, JC, maybe you can pull that number. The duration on the 10-year Treasury bond, by definition, is 10, right? Genius. That is the duration of a 10-year U.S. Treasury bond, 10. That's why it's called a 10-year Treasury bond. And where are we on the yield?
About 4.66.
So we have a yield that is 4.6 on a 10 duration for the 10-year Treasury bond. Our fixed income portfolio instead is giving you the same yield on the 10-year Treasury bond for a fraction of the duration, fraction of the interest rate risk, right? So that's what a diversified portfolio can do. If we just went out and bought you a bunch of 10-year Treasury bonds, you'd have a duration of 10, meaning you'd have higher interest rate risk. Sometimes having more duration is a good thing. But right now, you're not getting paid any extra interest for holding a 10-year Treasury bond with a 4.6 yield than you are holding our fixed income portfolio with the same yield and 3.4 on the duration. So this is what we're doing, which we think is very productive for your fixed income portfolios. Same yield, much less interest rate risk on that fixed income portfolio.
Okay, so model diversification. So if anyone wants to be a part of any other model that they're not currently in, we can do that. We can do it by your different account types. We can do it in one of your IRAs and one of your taxable accounts. We can split accounts. So if you want to split your IRA into two, we can split it by almost any percentage. So we can do 50-50 and put one model into one IRA and another model into the other. The only things to consider are potential taxes, especially in obviously in the taxable accounts. And then some trading and reporting costs will probably go up with the additional accounts.
Modestly, I don't think those are, they're not crushing costs, but they'll be a little bit, higher.
But they're there, yeah.
Yeah.
And of course, consultations are welcome. So if anyone wants to talk with us about whether they should do it, want to do it, we're happy to have meetings and calls to do that.
And this is why we made those models. We made the models so that we actually called, should I tell everybody what we called the project to make the models? Okay, JC says yes. We called it Project Whopper. You all may remember Burger King had an advertising campaign, Have It Your Way. You know, you can make your hamburger your way. I think it might have been the 70s or 80s. And so JC doesn't remember that because she wasn't around. But so we just said, you know, we want to make it possible for you to have your model your way, whether that means you want a global core model or a global market model or a US core, US market model, whatever you want. If you want some of it in one account, some of it in another account, if you want one type of account, we can do just about anything with it. But we should talk about it. And you may not want to do anything. I haven't made any changes in my model allocation in my accounts. But if you want to, we're perfectly happy to talk about it and to do it. And we have some talking points around, you know, sort of, would you be a good candidate? Would you not? And we can talk about that on an individual basis. Current market conditions. The S&P 500 at inflection points. And again, most of these slides, if not all of them, come from our friends at JP Morgan. Here's where we are as of January the 13th. We're trading at a forward price to earnings ratio of 21.2 times the index. And you see we've been on a long run up from the lows from 2022. Most of you don't even remember that we had a bear market going here in 2022 when the stock market lost 25% from peak to trough here. The bond market lost around 13%. This was occurring as the Federal Reserve was reflating short-term interest rates. But since that time, up about 63%, very significant rise. This chart goes all the way back to 1996. You know, we're trading toward the upper reaches of valuations. And you can see that here, that these are peaks in valuations. This was the tech bubble back in 1998 and 2000 when the S&P forward PE ratio reached 24 times earnings. And we're below that, 21 times earnings here. We hit around 22, a little bit over that in 2020, just before the pandemic. This is recovery out of the pandemic. Sorry, this was the pandemic. But you can see that we're above certainly the 30-year average on the S&P 500, 16.9, and we've even crossed above one standard deviation, 20.1. So we ain't cheap. This is cheap, this is cheap, this is cheap, this is cheap, you know. You can see cheap on the valleys of the chart. This is average, right? And this is in the more expensive areas. I don't think that's unknown to most of you that we're in a more expensive environment in the US S&P 500, but not all areas of the S&P 500. I think this is a really interesting chart. And it's a little dizzying to look at when you first look at it, but these are all the observations, monthly observations beginning back in 1999 of PE ratios and returns. So the PE ratio is here, the observation taken at the monthly observation period, and then this is returns on the y-axis, and this is subsequent one-year returns from that monthly observation, and this is subsequent 5-year annualized returns from that observation, right? So we go a month, we take an observation. We go a month, we take an observation, and that observation is being looked at in the past, right? So we can look back at monthly rolling observations and see how did the market do? How did the S&P do? How did the stock market do as encapsulated by the S&P 500? How did it do subsequent to that monthly observation? And then we move forward a month. And what you can see is a whole bunch of negative returns here in the 1 year period subsequent to an observation where the valuation on the S&P 500 was in the 20s. You can see that very clearly that when we hit these observations, 20 times earnings, 23 times earnings, etc., we get a clumping of negative returns in the 1 year after that observation. Now, we have some positives too. Look at this. It's not impossible that we get positive returns, sometimes very positive, right? In other words, this is showing you that it is possible that an expensive market can actually put up some really bang up returns, almost more likely to put up returns in the 20s and 30s and 40s than we would in the, 5%, 10%. We might call this bubblicious behavior, right? Or expensive-alicious behavior that can happen, right? But we can also get negative returns. You can see that the vast majority, this where we get really a big clump of positive returns 1 year after a reading occurs in a much less expensive market. You can just see that, right? And you can see that the trend, right? Here's the trend line on the observation is downward, which means as the market gets more expensive, we would expect that we would see lower returns. We generally associate higher returns with lower valuations. Now, this is more not firm data, but this is more signal data, right? The R squared 20% is higher. The correlations are higher. 5-year annualized returns. And what you can see is that in the 5 years after an observation, generally you can see that in the more expensive parts of the market, 20, 23 times earnings, we get pretty noticeable negative returns, but we can get positive returns also, right? The longer the time horizon means that we can also get more positive returns, although we don't see anything in the 5-year annualized return period where you're earning 20% a year annualized returns year after year when the market is this expensive. But we do when the market is less expensive. But we can also get negative returns as well when we have a less expensive market. Okay, so we can't draw completely absolute firm conclusions from less expensive and more expensive markets, but we can make some generalizations about it. Let me know if there are any questions about that. I love these charts. Very, very informative. Value versus growth. We're in a period, and we have been in a period for many years now, since 2015, when value stocks are generally less expensive, are viewed as being cheap versus growth stocks. But people didn't really count on AI exploding the way that it has, but it has. And that has really driven a lot of growth over the last year or so. We can also see in this chart that when we have higher U.S. 10-year Treasury rates, and we have now higher U.S. 10-year Treasury rates, which I've talked about in this call, we really saw in the fourth quarter of this year, when we are now firmly moving toward 5%. Don't know where it's going to go. Could go back down, but we're near 5%. JC just quoted it at about 4.6%, moderated over the last few days. But when we get that, we clearly see that the value part of the market is competitive. And if we cross 5%, the value part of the market has actually outperformed the growth part of the market. Whereas when we have really low 10-year Treasury interest rates, the growth part of the market does significantly better. We're in this area right now, and we'll see where it goes. Again, your portfolios hold both. You hold both value and growth stocks. So, you don't have to choose. They're both there, but I just want everybody to see that there are implications for the performance of different sectors of the market based upon where the 10-year treasury is trading. And this is where we're at right now. Concentration. Everybody knows we've got some mega stocks, and I'll show you those in a second. And we have reached, dating back to 1996, an all-time high on concentration of the top 10 stocks in the S&P 500 at least. 38.4% of the S&P 500 is now constituted in the top 10 stocks. So we have concentration, and with concentration comes risk, but also comes the potential for reward if those companies continue to do what they've been doing. But you can see that the valuation on the top 10 stocks, the PE ratio, is almost 30 times earnings, 29.1 to be exact. The remaining part of the S&P 500 is 18, much cheaper than the top 10. And we're now well above the average from 1996, well above. 20.6 is where the average of the top 10 stocks have been. So we're in a period when the top 10 have been, what, I don't want to say taking over the world, but boy, they've really been growing rapidly, and that's why they dominate the overall stock market the way that they do. This is the Magnificent Seven, and that's Microsoft and Apple and Google and Tesla and so forth. This is showing, you can clearly see that the Magnificent Seven returns have outpaced the S&P 500 here in gray, and of which they are a part, but if you take them out, here's the remaining part of the stock market, the S&P 500, top 500 largest stocks. If you take the Magnificent Seven out, this is the return, still good return, but boy, these seven have really hit lights out, and you can see their earnings per share estimates versus the earnings per share outside of the Mag 7. Now, there's no free lunch, right? That leads to much higher valuations, and whenever valuations go way up, all things equal, that means that returns in the future might go down, right? Growth has to continue to keep up or they could go down. And you can see that asset class valuations, this chart I've shown you many times over the years and quarters of webinars, you can clearly see that U.S. stocks are trading toward the upper reaches of their valuations, right? And here we have other classes that are trading in more inexpensive valuations, whether that's treasuries, municipal bonds. This is international stocks, both developed market and emerging market equity, trading below their averages. And then in between here, U.S. small companies. This is mortgage-backed securities and asset-backed securities and United States investment grade, even U.S. investment grade bonds and U.S. high yield bonds are trading toward the upper reaches of their valuations. It's just a measure of, we've been in a bull market for both U.S. stocks and for high yield bonds. These are all in your portfolio. But just want you to see that, some diversification here gives you allocation to some less expensive parts of the market in case we get a contraction in the market. A little bit of some macroeconomic stuff and policy stuff. Lots of talk about tariffs. This is what is being proposed. You can see that since the 1930s, the duties collected on U.S. imports as a value of total goods on imports for consumption, right? And you can see that these range from 0% all the way up to 20%. The highest we've seen in U.S. history dating back to the 1930s was 20% or so. You historians out there may remember something called the Smoot-Hawley tariffs. SMOOT. Hawley, Hawley. There's actually a senator from Missouri, Josh Hawley. I don't know that he's any relation to the Smoot-Hawley tariffs. I don't think he is, but Senator Smoot and Senator Hawley back in the 1930s, when there was a lot of anti-immigration sentiment that began in the early 1920s and resulted in an immigration law in the early 20s. And then we had high tariffs that were passed through the Smoot-Hawley tariffs that resulted in retaliation by foreign countries, and many economists attribute the Great Depression as having been contributed to very significantly by the Smoot-Hawley tariff law, when tariffs, as you see, rose and rose, and then they began to back off, right? As we approached World War II, tariffs dropped. We had a jump up in the 1960s, but since then it's been down, 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 down. President Donald Trump raised them, right? But nothing in the first term approaching what is being contemplated. This is being contemplated under the new administration, and this is JP Morgan's slide. So I take it as being having some authority to it. But you can see that what is being contemplated in these tariffs isn't this, and it isn't even this, not even this. It is being contemplated that it would put tariffs back the way they were under Smoot-Hawley back in the years of the Great Depression. I can't tell you what the effect would be. There are many people not unconcerned. I can't tell you that what we got back here is what we'll get here, but I'm simply showing you the slide and discussing the historical context for tariffs. Let me know if there are any questions about that. Treasury yield curve, here we are as of just, a day or so ago. And I've been talking about the 10-year Treasury quite a bit. It was at 4.8% on January 13th. It's backed off. JC told us 4.6%. But what's interesting here is that you can see that the current yield curve is no longer downward sloping as it was in July of 2023, when short-term interest rates were higher than longer-term interest rates. And even here in October, later that year of 2023, when we got the peak on the 10-year Treasury right here at 5%, we were still in a downward sloping yield curve. And since then, we now have higher long-term interest rates for the most part than we have for shorter-term interest rates, right? But to really make a whole lot more than the 4.5 or 4.4 here in the 2-year and the 3-year, or even the 4.6 in the 5-year, you go out to the 20-year, you're not getting paid a whole lot more to hold a 20-year Treasury bond than you are to hold a 10-year Treasury bond, or even a 3-year Treasury bond. So we're staying away from here. We're not willing to commit your money to really long-term bonds just to get an extra 20 or 30 basis points. But we are in a mildly upward sloping yield curve. And the question that JC and I had for a long time, not just us, all professionals, was how would we get there? Would we get there from a big drop in short-term interest rates, or would we get there through a rise in long-term interest rates? And I think we're getting that question answered now with the recent rise in Q4 of longer-term interest rates. And there are some who are saying, we may not stop there, right? We may see this 10-year break through 5%, and we may see a 20-year go closer to 5.5%, and a 30-year go closer to 6%. If I was betting, I'd say that's probably what we'll see, but I'm not betting on that because interest rates can never be predicted. Here's one on inflation. Everybody knows inflation has fallen from the peak in July of 2022. We had an inflation reading today that was pretty mild, but not totally mild. Markets are up strong in response to equity markets are up strong in response to that. But everybody can see that we have not returned to the 2% level in overall inflation. We are stuck really around a 3% rate of inflation. President-elect Trump, I think, was asked about that the other day because he was saying that he was going to bring inflation back to this area. I think he said it's really hard to get back to this area. It really is. And so I don't know that we're going to see 2%, but that's the goal of the Fed. That's the stated goal of the Fed. But you can see we're kind of stuck around that 3%. Here it is right here. And don't know whether we will get back to a 2% inflation rate. I think many people think we are not likely soon to do that. So moving forward, this is sort of a final draft that we've been thinking about and talking about. JC and I have been at work for really a couple months since the election on some changes that we might make to our models. We've looked at a bunch of different options. We've looked at some private stuff. We've looked at some ETFs on some people that we've been talking to. And where we've gotten and what we're contemplating are sort of three moves. The first one, we are thinking about adding Berkshire Hathaway to everybody's portfolio. I own Berkshire Hathaway personally. We've have some clients who own or have owned Berkshire Hathaway. It's done very well, about kind of like the S&P 500, but it's done it at different times, I think is the main idea. In 2022, the S&P 500 fell 19%. You probably don't remember that, do you? But it did. Berkshire was up 3.3% that year. That's a huge difference in performance, 22% difference. And there have been other times, and Warren Buffett himself has said, expect our company's stock, Berkshire Hathaway stock, to lag when the market is barreling ahead, but you also might expect it to outperform when the market has trouble. And you all told us at the beginning of today's meeting through your survey that you've got some concerns and you're not alone. And so JC and I have really been thinking about defensiveness more than we have about going on offense. I think a lot of our clients want us to be thinking about that. You know, it's sort of like offense takes care of itself, but defense you kind of have to think about. And so we've spent a lot of our time over the last couple of months thinking about defense because of the nervousness. And that nervousness really is not dependent upon any political orientation. People just have a certain nervousness about markets right now. And that may be given the valuation picture that we have talked about. And so Berkshire is a financial castle. That's how Warren Buffett thinks about it. It's a Fort Knox. I think he's even described it as very large amount of cash holdings right now. They've raised their cash holdings to several $100 billion, $300 to $400 billion, and has been a seller of stocks. Hasn't commented on it, but anytime Warren Buffett sees high stock market valuations and is unable to find things to buy, he will grow conservative in this way. And so we're thinking clients would benefit from that conservatism. It's a highly diversified company. It owns many other companies, wholly owned subsidiaries from energy companies. Mid-American Energy owns insurance companies, and it also, of course, makes investments and buys minority positions in publicly traded stocks. For example, it's been a huge acquirer of the stock of Occidental Petroleum here in Houston. He really likes it and thinks it's cheap. Was a buyer of Apple stock when it was much cheaper, but has been a seller of it recently as tech stocks have gotten more expensive. And of course, what you're getting with Berkshire Hathaway is really history's greatest investor. However, he's in his early 90s now, and so that is a risk. But he has been at pains to put in place his succession plan and a strong board and strong managers who have been working with him for decades, and they will continue to be there and to operate Berkshire Hathaway in the way that it has operated. However, I want to warn everybody that Warren Buffett will never be replaced. There is no replacement for him. So you'll let me know if there are any questions or concerns about that, but I do expect that Berkshire would give some defensiveness at a time when U.S. stocks are on the expensive side. BINC, B-I-N-C, is an ETF. that is sponsored by one of our strong partners, BlackRock. It's managed by a man named Rick Reeder, who is BlackRock's top bond manager. It's a core bond plus. There's nothing really sexy here, but it just gives some additional access to bond markets that you wouldn't get in just a plain old bond index. It's an actively managed, so-called actively managed bond fund. Recent performance in 2024 was very strong versus the benchmark aggregate. It put up 5.76 versus 1.31, but it's also very, very highly diversified. And so we think this would give some good outperformance versus the vanilla bond index. Nothing wrong with the bond index, but we're getting BlackRock, which is known as a bond manager, getting their best thinking through their top manager. And so this is a potential add to the portfolio. Now, for the big one, I don't know if I want to use I just want to say now for the sort of the tough one, we have been strongly thinking about adding a Bitcoin allocation to client portfolios. It would be a Bitcoin ETF. It's BlackRock's. This was released back in January, and we've been studying it and talking with BlackRock ever since. Extraordinary performance last year, and Bitcoin has been the single really best performing asset of the last 15 years. But there are arguments that it's even still early days, that what Bitcoin represents is digital gold and a global store of value that is going to grow in its use and in its allocation over time. We're thinking about a very small allocation, which is what BlackRock has discussed in its own model portfolios, 1%, 2%, 3%, something like that. And there are some indications that Bitcoin has performance that is offering some diversification benefits from stocks and even from inflation, that it may function somewhat as an inflation hedge. I put a question mark there because it's early days to determine that, but there have been some indications because of its restricted supply. It's restricted only to 21 million Bitcoins that would be issued, that it may have some inflation fighting capabilities. The new Trump administration is, I really don't want to say all in, but all indications are that it's going to be much less onerous, and I don't even know that that's the right word, but much less observant of a regulatory regime regarding Bitcoin and cryptocurrencies in general than the Biden administration was. Nevertheless, there is controversy about Bitcoin, but our question simply is, despite controversial aspects of it, do we think that it has a place in portfolios? And I think we've concluded that it is worthy of having a place. Now, Bitcoin has drawdowns. There are times when Bitcoin loses a large piece of its value. And I'm talking down 70%, even 80%. So when we talk about, let's just say, a 2% allocation, if it's a $1 million account that we're talking about, right? What is a 2% allocation? It's $20,000, right? So that's to put it into perspective. Our intention is not to put a 20% allocation, right, which would be a $200,000 allocation in a $1 million portfolio or account. It's 20,000. So I want to keep it in perspective for everybody. That's us giving credence to several, most of you who said, I've got some concerns about it. I want to show everybody that we're looking at this in a portfolio context. And what this is showing, and this is not new data actually, because the 2024 data is not out yet, but we'll get that out whenever it emerges. We're just still early days in 2025, but this is January of 2014 to December of 2023. And what you can see here is that this is a 60-40 portfolio in blue, and you can see the returns for a 1-year period, 3-year period, 5-year, 10-year. Here's the volatility also over a 1, 3, 5, and 10, and what's known as a Sharpe ratio, 1, 3, 5, and 10. Sharpe ratio is the return of a portfolio or an asset minus the return on a risk-free asset, generally thought to be the 10-year Treasury bond, divided by the volatility of the risk-free asset. That's Sharpe ratio. And it enables you to look at different assets in comparison to each other, right? You would never compare the performance of a bond to the performance of, or a bond fund to the performance of a stock fund. They're two completely different things, and you wouldn't ask bonds to provide returns that are stock-like. You're asking bonds to provide capital preservation. So how do you compare a bond portfolio with a stock portfolio? And the answer is Sharpe ratio, developed by a Nobel Prize winning finance academic named Bill Sharpe, who taught at Stanford for a long time. And I love Sharpe ratio because it allows you to do these comparisons. Okay. So what you can see is that adding a 1% Bitcoin allocation to a 60-40 portfolio enhanced returns by over 1% for a 1-year period, and 40 basis points and even more, almost 1% here, substantial amounts of increase in the return for not very much increase in the volatility of the portfolio, right? So you got return without adding much volatility in a 1% allocation, and a noticeable increase in the Sharpe ratio as well. A 3% Bitcoin allocation added even more meaningfully to the returns, right? You can see that over the portfolio that has either a 1% or no allocation at all. And yet still the volatility overall remained in a manageable place, right? Over 1, 3, 5, and 10. And you see that the Sharpe ratio was raised noticeably over those. So this is the portfolio context. We're not looking at it just to take a flyer on it. I believe there are notable and real benefits to a digital currency, long term. And even though Bitcoin's been out for a decade or so, and it's really only been able to be purchased in a form that a financial advisor could do in a compliant way since 1 year ago, we're in many ways what is potential early days for a digital store of value, and that is able to be accessed all over the world in the same store of value. And we don't want our clients to miss out on Bitcoin and the potential if we are in those early days. So let me stop there. I know there are concerns. I know that there are environmental concerns, that it takes power to power both the internet in general, and also to power miners who are mining for Bitcoin. I understand those concerns, and I'm not minimizing those concerns, and I'm happy to talk with any client about it. I also have a fiduciary obligation to think about things. So let me stop and take questions.
We do have a question that came in.
All right.
It says, what is your perspective on alternative cryptocurrency to Bitcoin? What if Elon wants to resurrect his own coin? What is to say Bitcoin is it?
It's a great question. The other one we've looked at is Ethereum. Ethereum is very interesting and has other benefits. Ethereum works very successfully as a facilitator of contracts because it focuses very heavily on the blockchain aspects on blockchain, on using blockchain to be able to add all sorts of definitions to contracts, and that can help facilitate digital transactions, whether it's the sale of a house or trading the stock. All sorts of other things are needed to be defined when you trade those sorts of assets, and Ethereum really excels at that. And BlackRock has an Ethereum fund, and we have it on our watch list. But not but and I think it's pretty indisputable that in terms of the world's primary uh, digital currency, digital store of value, it's Bitcoin. So those are the two that we would really even consider. Are Bitcoin, and Bitcoin, we have reached a point where we are willing and able to put it into client portfolios. Ethereum is for another day, and anything else, Dogecoin and so on, the answer is no. We have not green lighted that in any way, and not even begun to look into it. We don't see the reason why we would do that. I'm happy to look at other things, and we may eventually do that. But you know, we have to be cautious, and we have to be conservative for you. We don't want to lose your money, and we don't want to catch you up in anything that hasn't gone through a vetting process by really accomplished and successful financial firms. And the fact that BlackRock, and there are others as well, you know, we had maybe 12 launches over the last year since the SEC green lighted ETFs for Bitcoin and other cryptocurrency. Um, you know, so it's not only limited to BlackRock, but the IBIT fund, IBIT, is the largest, and this is why you count on us to make business partnerships with the biggest of the big and the best of the best, right? And so the slide I'm showing you, I can tell you, JC and I mean, I could show you lots of slides on Bitcoin. And by the way, if you're interested and you want us to send you um, um, any of the presentation materials that she and I have been digesting for, you know, months now from BlackRock, we will. But this is why we have these business partnerships, so that we have access to information and theories, so that we can bring things to you, hold this webinar, and then put things into your portfolio that have gone through a due diligence process. You count on us to do that. You're paying us to do that. And so Bitcoin has cleared the bar. But you know, Dogecoin has not. And with all due respect to Elon Musk, and he's due a lot of respect, we can't put our clients into things that haven't gone through due diligence, and we've been due diligencing this for you know, several months now. Other questions,
Yeah,
Catherine? Any other come in?
yeah, we've got another one come in. It says,
Yep.
how is this different than investing in the old tulip bulbs that kept going up because everyone else kept investing too, especially in light of such.
It's a great question, but um, tulip bulbs can't be turned into cash in Africa, you know, and someday Antarctica. And tulip bulbs can't be accepted as currency in the, you know, the dead of winter in Moscow. And tulip bulbs uh, would be looked at here in Houston, Texas, as as some sort of mystery as to what they are. So there are very, very significant differences between tulip bulbs and a global digital currency. Bitcoin is more equivalent to gold. If you have to make it equivalent to something, it's equivalent to something that has for thousands of years been accepted as a currency. I'm not big on gold um, for a number of reasons. And I would prefer to look at something that is viewed as a global store of value and a global currency in the form of Bitcoin than in gold. We have some clients who like to hold gold, and we bought it for them, and actually it's done well lately. But in a way, to me, Bitcoin is the replacement for gold. It's something that is recognized and increasingly will be recognized throughout the world as something that will be accepted as a means of exchange, already is accepted as a means of exchange, and also as a store of value where you can place uh, value into it and it will hold that value, maybe. Just as we can say maybe the stock market will hold its value, or maybe the US dollar will hold its value. The future is uncertain, and we don't know for certain what will hold its value over the long term. You know, some people might say, I want to put it into, furniture. I think furniture is going to hold its value, but I my first career was in computer networks, and there is something to be said very strongly about a currency that is digital, that is global, that is universally accepted, universally accessible. Um, that looks a lot different than a tulip bulb to me. Now, if tulip bulbs suddenly don't have transaction costs to ship them and are accepted all over the world, and so on and so forth, then I might be prepared to say those tulip bulbs are awfully valuable. But I don't think we're there with tulip bulbs, and that came and went, and other things have come and gone. I mean, whale oil came and went. So just because something ran up and came back down doesn't mean necessarily that something else will. I mean, lots of things recently have come up and run back down. Look at Moderna stock. Does everybody remember COVID? Does everybody does anybody have anybody who came to them and said, "Oh, you got to own Moderna stock. It's making the vaccine." Well, if you look, Moderna stock has lost 90% of its value since its peak. Anybody who piled into Moderna at $400 a share, it's at $40 a share right now. Okay? And how about what we're using right now to communicate with each other? Zoom. Zoom stock, right? It was going to the moon and you had to own Zoom stock. And it hit $400 a share. And it's now, I don't know, at 50 or 60 or 70 or something. So everyone's always making bets on, what will hold value and even go up from there, So we do our best to try to make these predictions. And at one point in time, people thought tulip bulbs were that, and they thought whale oil was that. But we're in a globally interconnected world with an internet right now, and all signs are that interconnectivity is only going to spread, frankly, thanks to people like Elon Musk, who now are saying, well, you can get the internet not only through your home or your mobile phone and cell towers, but through a satellite service that he calls Starlink. And so every time the internet itself expands and makes access possible in a more universal way, that makes the things that operate on the internet even that much more valuable, right? And Bitcoin operates on the internet. No internet, no Bitcoin. Internet, more and bigger and more and everywhere, that makes Bitcoin and other things as well more valuable. More questions. Great questions. Fabulous questions.
Yeah, we've got another one. Excuse me. So since you were talking about crypto tulips and vaccine producers, what about exposure to AI? As certainly there will be winners and losers. How are we exposed to AI? How do we benefit and avoid the risk that may be a bit like the dot-com bubble?
Your U.S. fund, your stock funds hold, your top 10 holdings in your U.S. stock fund are NVIDIA and Microsoft. They're in your U.S. fund, and so you are participating. You're participating in Bitcoin too, albeit indirectly, because Bitcoin relies on semiconductor sales and fiber optic sales and so on. And AI is a area that is being built by many companies, among them and chiefly among our biggest technology companies, which are at the very top of your stock funds. So if you look, for example, at a fund like DFAC, right? The top holdings, maybe 5% or 6% is NVIDIA, and the next 6% or 5% is Apple, and the next is Microsoft, and the next is Google. And these are the companies both making AI algorithms and building AI data centers, and building, in the case of NVIDIA, AI chips, or in the case of AMD or Broadcom, et cetera. So the market is valuing those very, very highly. And if we get any fall off in the growth, then they're going to be impacted for sure. So that's why we don't only put you into that, and we put you into a diversified fund. So you are participating in it. And the idea here is that we would give you a direct holding in Bitcoin itself. It's a great question. Next question, if there are
we've got
any.
another one. This
Okay.
was a follow-up to a previous question. Says the second part of my question is the more important point. Maybe a different cryptocurrency, such as you mentioned, is more reasonable consideration, though I do not know much about any of them.
I don't think so. The word is reasonable that was used by the questioner, and I don't know what we mean by reasonable. We're interested in giving you access to the most significant, most important of the cryptocurrencies. That is Bitcoin, unquestionably. So I guess if the questioner will clarify what reasonable is, that's what I would consider to be reasonable. That is me using my reason and reasoning functions and coming to a reasonable conclusion that it is if we're going to give you some crypto holding, that is the right one. And by the way, we could go even more. We could buy you stock in a company called MicroStrategy, which is very interesting. And if anybody's interested in looking at a talk from the chairman of MicroStrategy, his name is Michael Saylor. MicroStrategy is a company that buys only Bitcoin and issues debt on its balance sheet, uses its balance sheet to buy Bitcoin. And therefore, what you're getting with MicroStrategy is leveraged Bitcoin, meaning whatever Bitcoin does, up or down, it's going to do 2 times that or so. It's going to have so it's a levered up using debt strategy, and I haven't gone that far, because that could take a ride both up and down. So we're trying to do the thing that is reasonable, and that is IBIT, BlackRock. And by the way, there's $50 billion. Now, most of those investors in IBIT, we know this because we talked to BlackRock, are retail investors. They're not financial advisors. So we're on the earlier side for financial advisors. There are quite a number of advisors who have added cryptocurrency, and specifically Bitcoin, to client portfolios, but we don't want to be the last. We didn't want to be the first, but we think a year has gone by, and we've talked about it and studied it a lot, and we think it makes sense.
Yeah, let me finish up. So this question that originally came in had a second part, and I didn't get to read that.
Oh, okay.
So the question regarding the tulip bulbs that said, how is it different than investing in the old tulip bulbs that kept going up because everyone else kept investing too? And then it says, especially in light of such a large percentage, like 60% or something, that is unknown who owns, that might result in market manipulation.
It's a great question. Part of the point of Bitcoin is that you don't know who owns it, right? It's intended to provide privacy. And I understand that people are using that privacy for illicit purposes. But you know, I can't stop that, and nobody's going to stop that. That doesn't invalidate the overall systems architecture of Bitcoin, its concept, its benefits. It doesn't invalidate that any more than digital video is invalidated in its totality by something like the distribution of child pornography through the internet, which is an odious effect that comes with new technologies. And so people are using Bitcoin for illicit drug trading and arms trading and so forth. I understand that. But it doesn't invalidate the overall architecture and really genius of the architecture. Bitcoin was invented by an unknown person, by the way, has a pseudonym of Satoshi Nakamoto. Nobody really knows even who that is. It's a very fascinating thing about it. But even that doesn't invalidate the architecture in the universal acceptance of Bitcoin. And so its anonymity, its privacy is part of its design, because it allows you to make a trade with somebody without having counterparty risk. I don't have to know if the person I'm trading my Bitcoin with or giving it to or taking it from, if they're good or bad person. I can trust that it's Bitcoin and therefore it's going to be money good. And that is the point. That is the whole point. And that's what makes it so globally compelling because of that. So in some sense, the anonymity of it is the point, and is the value of it. I can't stop what people are going to do with anything or with Bitcoin any more than I can stop what people are going to do with firearms or what they're going to do with a Ford F-150, which somebody did a horrendous thing with a Ford F-150 in New Orleans recently. And so we're not going to stop what people do with Bitcoin. I'm sorry to say that we're just not, but it doesn't invalidate the benefit of an F-150. And there are very beneficial uses for a firearm, hunting to procure food or defending yourself from someone who might be violent. Same thing here. I hope that's, you know, I could go on about it for a while, but I think I've said enough about it, and hopefully that makes some sense. Any other questions? I appreciate all of the questions very much.
Nothing else as of right now.
Well, look, everybody, thank you for your time today. It's great to have you. I wish everybody a wonderful afternoon. And for those of you joining us from Houston, button up, I think, coming Sunday, and cover your pipes and stuff, because every year it seems to get me, and I seem to have something blow up. And I'm hoping this is going to be different this year. I really want to not have stuff break. And so I'm going to be working on that. Thank you all very much. And anything that you still have questions or concerns about, please don't hesitate to ask. We'll be more than happy to spend some extra time with you. And take care. Catherine, thank you so much. JC, thank you. It's great to have you handle so much of the presentation. And especially what you all don't see is that JC spends a lot of time putting those slides together and doing the computations on the model portfolios. It takes a lot of work to put all those numbers together to be able to present it to you, but we're committed to showing you what the models are doing, right? We want you to know, and we want to be fully transparent with you so you can come to some conclusions, and we can help you do that. And then thanks to everybody else at New Capital. Let me mention Casey, who does such a phenomenal job on the administrative side of things and helping clients move money. And our latest addition, Daisy Davila, who has been taking on more and more roles and is just terrific. It's great to have her. So thanks to everybody. These webinars are a group effort, and none of us could do it by ourselves. Thank you.